Ladies and gentlemen, good morning. Welcome to the Q3 2016 results conference call. I am Maria, the conference call operator. The conference must not be recorded for publication or broadcast. At this time, it's my pleasure to hand over to Mr. Erik Olsen, CEO of LafargeHolcim. Please go ahead, sir.
Good morning, everyone, and welcome to the LafargeHolcim Q3 analyst call. I'm very happy to be here and take you through our third quarter results, which show sustained and accelerating earnings momentum. What you see is a result of teams fully aligned and focused on execution. Building on the second quarter performance, these results give us confidence that we will achieve the goals we have set for 2016, thus delivering a year of solid progress towards our 2018 commitments. Ron is here with me as well. He will provide a regional overview as well as going into more detail on our financials and latest outlook for the end of the year. As well, we have Alessandra Girolami, who's with us, who's our new head of investor relations. Let me start by giving you first my own reading of these results. First and foremost, these results show that we are delivering on our commitments. We are progressing fast with the implementation of our synergies, and they are visible in the bottom line. Our pricing strategy is driving real improvement. Cost reduction actions beyond synergies are gaining momentum. We continue to execute on our deleveraging targets with further progress in our divestments, and the results of our focus on cash flow generation are visible. Second, we have delivered this solid performance despite some volume declines in a limited number of markets, due primarily to a stronger than usual monsoon this year in India, which overall is a positive for us in the medium term. Secondly, due to energy shortages in Nigeria, which at this point are largely behind us. Thirdly, demand softness in a handful of markets, namely Brazil, Indonesia, and North America. And a tough comparison in Mexico last year where we had temporary increases in volumes in the second half of 2015. Overall, we are on track despite challenges in some of our markets. The strength of our diversified portfolio demonstrates that we can continue to grow our business while managing challenging issues in some of our markets. Our focus remains on high-value sales as opposed to a volume-based strategy. Now let me come back to the drivers of our performance, starting with pricing. Prices fell by close to 4 Swiss francs per ton during 2015, but they have now fully recovered and we are focusing on driving further positive momentum going forward. Our pricing results in Q3 are in line with our expectations. Price increases and product mix improvements in Argentina, in Mexico, the United States, and Algeria offset some declines in Poland, Indonesia, and Malaysia. They translated into a further small increase of our average pricing in Q3. This demonstrates that our focus on higher margin segments is solidly contributing to our results. With the exception of Middle East Africa due to Nigeria, our overall price-cost delta, before even taking into account any synergies, was positive in all regions in Q3. Turning now to costs, I would like to highlight 2 things. First, our teams have been accelerating the execution of the synergies, and these synergies are clearly visible to us on the bottom line. We have achieved our target for the year of 450 million Swiss francs in just 9 months, and now we expect to achieve at least 550 million Swiss francs of incremental synergies in 2016. This means that at least 60% of the overall synergy target of 1.1 billion Swiss francs will be completed by the end of 2016. Secondly, and as we've said, we are not limiting our cost savings to synergies alone. In the quarter, we have delivered approximately 100 million Swiss francs in ongoing cost savings through tight management of costs and productivity improvements. This excludes the benefit of lower cost of energy compared to last year, which translated into an additional net cost decline of approximately 40 million Swiss francs in Q3. Overall, our focus on price and costs, both synergies and ongoing cost improvement actions, has driven an increase in margins, which improved 290 basis points in Q3 compared to Q3 2015. I have always said that the benefit of these synergies would be seen in our margins, and they contributed more than 200 basis points to the improvement of our adjusted operating EBITDA margin this quarter. Equally encouraging is the positive 170 basis point margin improvement from the price-cost delta, excluding synergies, which largely offset the roughly 100 basis point adverse effect from lower volumes. Coming now to cash flow. As we have said in previous quarters, free cash flow is a key indicator for us. Here we are delivering good working capital performance, strictly limiting capital expenditure, as well as improving our underlying results and reducing our financial expenses. As a consequence, our operating free cash flow was up more than 800 million Swiss francs for the quarter. Coming back to our CapEx commitment, I'd like to highlight one important thing. The reduction of our CapEx is coming from lower expansion CapEx as we completed several large CapEx projects in the last year, which we are now able to benefit from going forward. However, about 70 million of additional maintenance CapEx is included in our year-to-date numbers compared to last year. The reduction in expansion CapEx is fully in line with our asset-light strategy. Going forward, given our footprint and the potential for optimizing both our logistics and our offer, we see plenty of operating leverage potential and opportunities to grow. And finally, looking at net debt, we've received the cash proceeds from our transactions in Sri Lanka and Saudi Arabia, together with the restructuring of our partnership in Morocco, which now also includes the Ivory Coast. It led to a net debt reduction of close to 1 billion Swiss francs in the quarter. We also received over 1 billion Swiss francs in proceeds for the India transaction during the first week of October. As we complete these divestments, we expect our net debt to be reduced to around 13 billion Swiss francs at year-end, in line with our target. This compares with 17 billion Swiss francs at the end of 2017 and is a clear indication of our commitment to a solid investment-grade rating. Before handing over to Ron, I would like to comment on a few trends we have seen in specific regions or countries that will continue to underpin the expected growth into the fourth quarter. In India, I explained that our volumes were impacted in the third quarter by a strong monsoon season, which is a positive for demand in the coming months. The other good news is that pricing continued to improve sequentially during Q3, and we will focus on this critical driver of ongoing performance well into Q4 and beyond. In Nigeria, short-term measures that we put in place in order to support production in Q3, such as importing already ground pet coke, led to pressure on costs in the quarter, which was also further exacerbated by the depreciation of the naira. While logistics and the level of market demand will continue to be a risk on our volumes, higher prices will contribute in the fourth quarter as price increases were effective towards the end of Q3. Combined with our reduced dependence on gas and the progressive ramp-up of our newly opened line at our plant in Calabar, we expect strong growth in profits in the fourth quarter in Nigeria. In the U.S., our operations delivered a strong performance despite softer volumes in the market in the third quarter as a result of delays in some project spending and difficult weather conditions in a few regions like Texas. However, higher prices combined with synergy delivery, notably on logistics, resulted in a strong increase in EBITDA margin and underpinning solid like-for-like improvement in results. Going forward, we expect the U.S. market to continue to be on a solid recovery path. And finally, let me highlight the great performance from our European team, driven in large part through focus on cost reductions and synergies. The European team overcame market challenges in Poland, Spain, and Azerbaijan, and a still subdued market in France. And we expect these conditions to continue going forward into the fourth quarter. With momentum in earnings growth and the expected turnaround of specific situations like in Nigeria and India in the fourth quarter, we confirm our target of at least high single-digit like-for-like adjusted operating EBITDA growth in 2016. This quarter, we have driven a strong and accelerated momentum in results and cash flow generation improvement. Our organization has hit stride and is delivering as one team. This puts us well on track to deliver a strong performance and achieve our targets, which will result in the potential return of additional cash to shareholders. On November 18th, we will come back with more details on our strategy and the various drivers of our value creation journey, as well as updating our 2018 targets. I'm looking forward to seeing you all in London. I'm now going to hand over to Ron to take you through the details of the results before we take your questions. Thank you.
Thank you, Eric, and good morning, everyone. Let me start with an overview of our key financial figures in Q3 2016. We successfully pursued our pricing strategy in Q3 and significantly improved our adjusted operating EBITDA margin, building on our progress in Q2. At group level, we achieved a small sequential average cement pricing improvement of 0.3% at constant Forex and country mix, and taking into account the scope impact. Our cement and clinker volumes recorded a like-for-like decrease of 4.2% in Q3. This takes into account the extended monsoon in India and continued negative impact from our volumes in Nigeria. We also recorded a negative volume trend in our aggregates line, which is mostly related to the market development in Canada. Net sales in Q3 were down 3.1% on a like-for-like basis compared to 1 year ago. Adjusted operating EBITDA increased by 10.5% like-for-like, which resulted in a year-on-year margin increase of 293 basis points to 23.9%. This shows acceleration versus the margin increase of 210 basis points recorded in Q2. Net income was up 34.5%, while recurring net income increased by 102%. CapEx spend of 399 million in Q3 was well in line with our plan as we continue to exercise strong CapEx discipline. Our improving operating EBITDA, largely reduced CapEx, and reduced net financial expenses resulted in a significantly better operating free cash flow of 856 million in Q3 compared to 30 million in the comparable period last year. In Q3, we received close to 800 million of divestment cash proceeds that translated into around 1 billion of net debt reduction. Since the end of the quarter, we have also closed a significant transaction concerning Lafarge India on October 4, while the Vietnam and China transactions are still pending. Taking into account the expected closing of these deals in Q4, we continue to expect net financial debt to reach around 13 billion by year-end 2016. Slide 8. Due to our well-diversified revenue and earnings mix, we are in a strong position to benefit from favorable local market dynamics. Similarly, challenging market conditions are mitigated at group level by the portfolio effect. Adjusted operating EBITDA of 1.7 billion is up 10.5% like-for-like. Excluding the impact of Nigeria, the like-for-like increase would have been 15%. It is also worth noting that all regions but Middle East Africa grew their adjusted operating EBITDA contribution on a like-for-like basis. Let me now talk about each region. Slide 9. In Asia Pacific, adjusted operating EBITDA margin increased by about 150 basis points to 17.8% in Q3. This was driven by a 6.7% like-for-like increase in adjusted operating EBITDA and a like-for-like sales decrease of 5.9%. In India, although a longer and stronger monsoon impacted sales during Q3, this actually bodes well for demand in the coming months as it boosts the local economy. Margins remained resilient versus last year as they were supported by the ongoing benefits of our fuel mix optimization. In other markets, business performance in Q3 was stronger year-on-year, particularly in the Philippines as a result of favorable market conditions, while in China, the ongoing work on cost continued to pay off, for example, through pooling of local coal purchases. Overcapacity and deteriorating market conditions led to profit declines in Indonesia and Malaysia. Slide 10. Europe recorded a strong performance this quarter. Adjusted operating EBITDA margin grew by more than 300 basis points to 22.1% in Q3. This represents a 16.3 like-for-like increase in adjusted operating EBITDA and a decrease in like-for-like net sales of 1.6%. We delivered a resilient performance in most countries, with improving overall trends in cement and aggregates volumes, supported by mild weather in September. That being said, the environment remains challenging in Spain, Italy, and Poland. We are seeing signs of stabilization in Russia, where pricing has improved. We reap the benefits of our ongoing cost savings initiatives across the board in the region, with things like the Business Shared Service Center and the IT Shared Service Center, as well as ongoing cost initiatives, notably in Germany and the UK. Lastly, it is worth noting that significant depreciation of the British pound has contributed to a negative forex impact of around 80 million on reported net sales and around 15 million on adjusted operating EBITDA. With the British pound currently at around 1.20 against the Swiss franc, we will expect a further negative impact in the coming quarter. Slide 11. In Latin America, the adjusted operating EBITDA margin was up by more than 400 basis points to 32.7% in Q3. This was driven by a 7.5% like-for-like increase in adjusted operating EBITDA, while net sales were down 7.4% on a like-for-like basis and down 14.9% on a reported basis on the back of currency depreciation. In Mexico and Argentina, our focus on pricing had a positive contribution to adjusted operating EBITDA, which more than offset the negative volume contribution in Q3. In Mexico, the comparison to last year was impacted by non-recurring project work in the second half of 2015 and volume increases linked to production issues at one of our competitors. Throughout the region, we have also successfully implemented cost measures, which have significantly contributed to margin expansion, notably in Ecuador, with organizational efficiencies in our plants and SG&A streamlining. In Brazil, volumes were significantly down year on year. As flagged earlier, we have taken additional cost measures in Brazil as market conditions will remain challenging in the coming months. Slide 12. Middle East Africa recorded a strong performance, excluding Nigeria, as the adjusted operating EBITDA margin was up more than 300 basis points in the quarter, accelerating from Q2 growth. Adjusted operating EBITDA grew 29% like-for-like. Including Nigeria, adjusted operating EBITDA margin for the region decreased by around 190 basis points to 27.2% in Q3, with a 5.1% like-for-like decrease in EBITDA. Net sales were up 1.4% on a like-for-like basis, whilst down 17.2% on a reported basis on the back of currency depreciation, mainly due to the Naira. The performance in Nigeria weighed on the region's performance. Despite further sequential price improvement, our volumes were disproportionately impacted by gas shortages due to pipeline attacks. Significant currency depreciation also weighed on our cost base, since around 25% of our costs are denominated in US dollars. Against these challenging headwinds, we have improved fuel flexibility and enabled production to recover to more normal levels by the end of Q3. We have also implemented measures to address logistics issues and restore full supply to our customers. In other markets in the region, the overall picture improved and performance was stronger than in Q2. Egypt and Algeria benefited from effective pricing, while cost improvements in Egypt and Lebanon contributed to growth in earnings. Slide 13. In North America, adjusted operating EBITDA margin increased by more than 400 basis points to 31.9% in Q3, driven by a 9.2% like-for-like increase in adjusted operating EBITDA and a decrease in sales of 6% on a like-for-like basis. In the US, we posted a strong performance supported by significant synergy and cost delivery. We continued to benefit from strong pricing trends in our markets, notably on the East Coast and in the Mississippi region, despite softening cement demand. After a very strong Q1, which was partly driven by favorable weather conditions, we saw volume declines in Q3 after a flat trend in Q2. The volume decrease was triggered by a combination of unfavorable weather conditions and a delayed start in some projects. In Canada, the situation remains challenging in the West, which continued to suffer from the lower demand generated by a commodity-driven recession in Alberta and Saskatchewan. Slide 14. I would now like to spend a few moments talking about the adjusted operating EBITDA bridge in Q3. The 73 million adjustment for scope comprises of 66 million of 2015 adjusted operating EBITDA for the divestments, with an additional impact from the disposal of smaller operations in some markets in 2015 on top of our ongoing divestment program. Our pricing improvement contributed 91 million Swiss francs in Q3, reversing the sharply negative contribution of negative 179 million in the first half. This offset to a large extent a negative volume contribution of 161 million in Q3, which is mainly attributable to Indonesia, India, Nigeria, and Brazil. The overall effect of pricing and volume is a clear improvement compared to the first half. If cement prices were to remain in line with their level at the end of September, the embedded pricing contribution would reach 130 to 150 million Swiss francs in Q4. The key performance driver has thus been a significant cost improvement due to faster synergies delivery and ongoing cost discipline. More specifically, we delivered 183 million of synergies in Q3 versus 274 million in the first half. We've also recorded 60 million of energy-related cost savings in Q3 versus 140 million in the first half, as we still benefit from lower energy prices and fuel mix optimization. At the end of the first 9 months, we are therefore well on track to deliver further like-for-like adjusted operating EBITDA increase. We have already secured our initial full-year ambition of 450 million incremental synergies in just 9 months. This outperformance makes us confident that we can deliver another 100 million of synergies in 2016. In addition, we expect to deliver further cost savings in Q4 with another 30 million expected for energy-related savings. Forex is expected to remain a headwind in the range of 210 to 230 million for the full year, with the effects of the depreciation of the British pound and the Naira in the quarter. Additionally, we anticipate a scope impact in the range of a negative 145 million for the disposal program for 2016. We currently expect a total of 400 million of merger, implementation, restructuring and other one-off costs in 2016 after spending 267 million in the first 9 months. Let us move to a focus on pricing trends, slide 15. After an initial sequential improvement in Q2 to plus 1.2%, we managed to accelerate over Q2 to 2.3% and to deliver an additional 30 basis points of improvement in Q3 in our average cement price. This rise was driven by pricing recovery in India, Nigeria, Argentina and Mexico, and was largely offset by price declines in Brazil, Indonesia and Malaysia. This is positive news, as Q3 is not typically a period where we see significant price increases. In our fourth quarter, we expect to gather further positive price momentum. Slide 16. With Morocco as an equity accounted JV, we thought it would be useful to remind you that our business delivers strong, also below the operating EBITDA line. For instance, a proportionate accounting of our JVs would lead to an additional contribution to our adjusted operating EBITDA in Q3 of 79 million. With a strong performance from operations in Morocco, this would have meant a 4.8% increase in adjusted operating EBITDA for the group compared to 2.4%. Slide 17. We have outperformed our initial ambition for 2016 by reaching 457 million of incremental synergies in the first 9 months of the year. Progress was made across all categories, with operational optimization and best practices, representing a quarter of synergies delivered in Q3, followed by SG&A, procurement, and growth and innovation. We are confident that we will deliver at least 100 million of synergies in Q4 2016. Slide 18. Looking below operating EBITDA, other income was 473 million in Q3 2016 compared to 620 million in 2015. The impact in Q3 2016 is mainly related to gains on disposals, with notably Morocco and Sri Lanka. The share of profit of associates and joint ventures in Q3 improved by 59%, mainly driven by the inclusion of Morocco into associates and underlying business improvement. Net financial expenses of 182 million are 43% below the third quarter of last year, reflecting synergy benefits arising from the merger and a lower level of financial debt in 2016. Tax for the quarter is mainly impacted by the non-recognition of tax losses, notably in Brazil and Nigeria, partly offset by the tax effect of the divestments. Our underlying normative tax rate stands at around 29% for the full year. Improving operating results, combined with lower financial charges, drove a nearly 35% of increase in net income in the quarter. Excluding exceptional charges, recurring net income more than doubled to the same period of last year. Slide 19. We have been able to post a substantial improvement in operating free cash flow, delivering 856 million in Q3 2016 compared to 30 million in Q3 of last year. All main components of the operating free cash flow contribute to this improvement, with higher operating EBITDA, lower CapEx, and notably a net working capital reduction of 121 million, as well as reduced net financial expenses and income taxes paid. Excluding exceptional cash outs, operating free cash flow is 994 million compared to 246 million in Q3 last year. Slide 20. Let me now turn to the debt picture. We have already made significant progress so far this year by reducing net debt by about 2 billion Swiss francs. This takes into account the cash proceeds of the disposals that we booked in Q2 and in Q3, namely Sri Lanka, South Korea, and Saudi Arabia. This together with the impact of the restructuring of our partnership in Morocco and Ivory Coast. The first part of the transactions in China to streamline our operations is expected for Q4, together with the closing of our divestments of our Vietnamese operations. Taking these two transactions into account, we continue to expect net financial debt of around 13 billion at the end of 2016. Slide 21. Let me come back and summarize the progress on our divestment program. So far, our already announced divestments led to a net debt reduction of close to 4.1 billion francs. Out of these 4.1 billion, we expect to book around 3.5 billion this year. As you can see, we are well on track to reach our extended divestment program target of 5 billion by the end of 2017. All these divestments were made at attractive multiples. Let me remind you that the share we own in some of our divested entities and the restructuring of our shareholding in Morocco and China impact this comparison. For example, in Morocco, the restructuring of our partnership led to a 33% equity stake in the overall Moroccan business. This change in stake enabled us to reduce the debt by 600 million. But obviously, we deconsolidated 100% of the EBITDA we previously had in our numbers. We estimate that the adjusted operating EBITDA contribution from already announced disposals that are either closed or are likely to be closed by the end of 2016 would have been 145 million compared with the number in 2015. Slide 22. Let me finish by looking at the improvement of our maturity profile and cost of debt. As a result of our refinancing activities in the first 9 months of 2016, the average debt maturity has increased from 4.2 years at the end of 2015 to 5.6 years at the end of Q3. In addition, the average cost of debt has been reduced to 4.8% at the end of September, compared to 5.1% at the end of December 2015. Slide 24. Let me conclude on the outlook for 2016. In light of developments in selected countries during the first 9 months, we expect demand in our markets to grow between 1 to 3% for the full year. Based on the trends we see in pricing and synergies expectation, our full year expectations on adjusted operating EBITDA remain unchanged. We continue to expect CAPEX to be below 2 billion and remain committed to achieve our net debt year-end target of around 13 billion francs, taking into account 3.5 billion impact of disposals. I will now hand back to Eric.
Thanks, Ron. We will now open for questions, and as we do that, I will ask you, as usual, to limit yourself to 2 questions so that we can give a chance to everyone to be able to participate.
The first question comes from Jean-Christophe Lefebvre-Moulenc, CIC Market Solutions. Please go ahead.
Yes, good morning, sirs. Also, good morning to the investor relations team. I have 2 questions. First, looking at the slide volume and price development cement 9 months, we have still a difficult situation in several countries, Switzerland, also Germany, and also Belgium, and conversely a turnaround in Spain. Do you have specific comments in that market? First, and secondly, Egypt. You didn't mention Egypt. We have now an announcement of monetary adjustment yesterday evening. What is the impact on Egypt future EBITDA? Could you quantify the share of costs related in US dollar in this country? Many thanks.
Okay, Jean-Yves, thank you for your 2 questions. Maybe Ron, you can take the question, or we can get back to you on the split of costs in Egypt. I have a general comment about Egypt, however. But on your first question on volumes,
price development. Price
development in those markets. Yeah, well, in Switzerland, you see, which is the big chunk that you see in that, we see the effects of the devaluation, and we had that working through the business. But we also see a strong improvement in volumes in Switzerland, and we see results improving in Switzerland, and the same in the other areas. I don't see a significant price decline trend going forward in these markets. In fact, if you look at our overall Europe performance in the quarter, despite relatively slow volume growth for Europe, we improved our EBITDA, as Ron said, by 16% quarter on quarter. So we're actually quite pleased with where we are in our European performance. On Egypt, yes, there was a devaluation this week, and as it affects our translation going forward, we believe that is will not be a negative impact on the overall construction activity in the country. But in terms of how it affects our cost structure, Ron, would you have a comment on that?
Yeah, we have about 20% US dollar cost in Egypt. Furthermore, on the forex impact, as you heard, I updated a bit our forex guidance for the full year from 210 to 210 to 230. So we extended the range a bit for that effect. We have to see how the Egyptian pound situation stabilizes.
Okay, just an additional comment on Egypt. Your energy is imported or locally purchased?
It's a mix of the two. We have a local petcoke source, and we also import as well.
Okay, thanks.
Thank you very much.
The next question comes from Elodie Rall, JP Morgan. Please go ahead.
Oh, hi, good morning, everyone.
Morning.
2 questions. So first of all, on cost, I know you mentioned various numbers in the Q3 cost split, but can you split that again? So that tailwind of 52 million, can you just split that again between energy cost savings and inflation, please? and how you expect that going into Q4. And second question on EBITDA expectation for the year. So if you exclude synergies in Q3, your like-for-like EBITDA was down 20 million Swiss francs, or 1%. And if you assume your guidance on synergies in Q4 of 100 million Swiss francs, then that means your like-for-like growth in Q4 EBITDA needs to be around 200 million Swiss francs. Can you split that between volume, price, and cost expectations, please?
So, Ron, why don't you take the cost question?
Yeah. So if you look at the cost bridge, as you rightfully pointed out, that's 52 million in variance. Then we take out the energy impact, excluding the energy that is in synergy, of about 30 million. If you then apply on the remainder an inflation of 120 million, then you come to the conclusion that we actually have a good cost performance. And that's what I basically say every quarter. The underlying performance trend is really improving. So that is a good sign. You asked about Q4. We don't comment on Q4, but we will stay with our high single-digit like-for-like EBITDA guidance. We feel that you mentioned the number of 60 million of energy saving, and the like-for-like would be down. But of course, like-for-like, we have to see across the board, because the 60 million is a nominal number. As said also earlier in my speech, we have exited September at a certain price level, which was 30 bips better average cement prices on constant forex and country mix than Q2. If that pricing would hold, we would have 130 to 150 million already of favorable pricing impact. And then I mentioned also the favorable tailwind that we still expect from energy, plus ongoing cost initiatives, plus the synergies of additional 100 million that we have teed up. Eric?
Yeah, no, so we're comfortable with the year number that we've given, and as Ron said, we just pricing alone is a significant quarter-on-quarter improvement, and specific country situations in India and in Nigeria are also going to be good contributors. The Q4 last year in both countries was quite poor, in fact, and we see underlying trends much better. Thanks for the questions, Elodie.
Yeah, so if you take the exit price increases that you've made at the end of Q3, what would be the impact on Q4 then?
We 130 to 150 million impact.
Yes. Okay, thanks.
Thank you.
The next question comes from Eric Lemarié. Brian Garnier, please go ahead.
Yes, hi, hello. Two questions from my side. On the U.S., first, you have apparently decreased your market expectation for North America from 2 to 4% to 0 to 2%. Is it due to Canada, or is it due to United States? And apparently the market is a bit slowing down currently in the U.S. Could you comment on that? This is my first question. And my second question on Malaysia. It's a big country for you. Could you give us more details on the current market situation? Is that going very well? Is it due to an overcapacity situation or something I missed?
Sure.
Thank you.
Yeah. Thanks for the questions. So in North America, yes, you're right. We took the market estimate in our markets down from 2 to 4% to 0 to 2%, and it's both Canada and the U.S., but for different reasons. We're seeing continued weakness in Western Canada, specifically in Alberta and in the prairies, driven really by reduction in activity around the oil sands investments and energy-related investments. And then in the U.S., whereas looking forward, we're very confident on fundamentals, on housing and on infrastructure spend going forward, 2017, 18, 19. We did see a weaker Q3. We saw Q3 volumes in the U.S. down 5%. And we don't see that as a trend going forward. It was more related to weather events and some delayed projects as well. But our read of it is not that it's an ongoing slowness in the U.S. economy. It's just a specific quarter where volumes were slower. But going forward into 2017 and 2018, we expect strong, good volume growth driven by great fundamentals in housing and infrastructure.
Okay, thank you. That's clear.
And then in Malaysia, coming back to your question, yeah, you're right. There is a more difficult market situation in Malaysia right now. We have an excess capacity situation. So there's a bunch of new capacity that came on during 2016, over the course of the year progressively, at the same time where the market is in decline. So the market pulled back. So it's that combination of a bunch of new capacity coming on at the same time as the market's pulling back a little bit. We believe that the market will correct itself going forward. Maybe not immediately in Q4, but we don't look at this as a structural problem for the next several years.
Okay. Thank you.
The next question comes from Yassine Touahri, Exane BNP Paribas. Please go ahead.
Yes, good morning. So 2 questions. My first question would be on energy and commodity prices. Energy and commodity prices have increased quite substantially over the past 6 months. Do you see this as a risk for the group because energy cost inflation will come back next year? Or do you think this could be a net tailwind because this could support further price increases and a recovery in countries exporting commodities? My second question would be on Canada. Could you give us an update on the new entrants? Do you know when these new entrant terminals will be operational? And could you also quantify how much of the group is exposed to New England and Quebec?
Okay, so let's start with energy. So yeah, we are seeing coal and pet coke prices trending upward. We don't expect it to be a significant impact on us in Q4, as it takes time for those cost increases to work through our system. But it will be something impacting the business, not significantly, but it will be an impact going forward. But we believe that net it is not a bad thing for our margins. It'll create a bit more inflation in our industry, and it'll help reinforce a positive pricing dynamic in our industry. But it is something that we're anticipating and we're planning for as we make our business plans next year. And we don't expect to have that as a negative drag on our margins. Plus, as energy prices increase, it also has the corollary effect of having a positive impact on some of the economies in which we operate in. On Canada in specific, yeah, I don't have anything specific to say about when on the competitive environment. We don't comment on competitors and what they're doing. But I can tell you that we're really focused on our business in Canada. We're focused on our costs and preparing to have a good year in 2017. And with our recent investment in our plant in upstate New York in Ravena, which is online in really January of next year, we have a modern state-of-the-art plant on the Hudson River in upstate New York. We are extremely well positioned to serve markets in the Northeast.
Thank you very much.
The next question comes from Robert Muir from Berenberg. Please go ahead.
Good morning, everyone. So 2 questions, if I may. The first one, just looking at the bridge for the quarter provided on slide 14 of the presentation. I was just looking specifically at the dynamic between volumes and prices, and then looking at your market forecast of 1 to 3% for the year, which I assume is sort of the wider market. It looks like you are losing some market share, and I assume that this is a reflection of opting for sort of pricing over volumes. And then with that in mind, the bridge suggests that it isn't quite working yet. Is your expectation that the dynamic between the two will reverse in the near future? And then can you maybe help me understand what the main levers are geographically to make this happen? For instance, maybe Nigeria, India, etc. And maybe if you can quantify anything that you think there. And then in the final quarter of the year as well, just a question. Do you have any view of the impact of incremental EBITDA caused by the rollout of capacity? For example, I'm not 100% sure, will Biskra in Algeria be consolidated into EBITDA? And maybe can you give some indication of the effect from Unisem? And also on that, is your solid fuel strategy in Nigeria, is that commissioned already, or will that be commissioned in Q4? Thank you very much.
Sure. Thanks, Robert, for the questions. So first of all, on the comparison of price and volume, as you're saying, I think that's not the right way to look at it. In the volume variance that you see, the large impacts in volume there are three factors. One is India, and it's the monsoon impact in India, where we had a significant decline in volumes during the quarter. We believe that will come back and that'll turn around. Secondly is a significant decline in volumes in Nigeria in Q3, which was driven by our inability to produce because we didn't have energy supply in the quarter. It's not a trade-off of price or volume there. And then the third really major driver is the U.S., where we have a large market for us, where volumes were down by 5% in the quarter, and there's no loss of share in our view associated with that. So you've got specific market issues really being the major contributor to that. And overall, when we look very closely at this, our pricing strategy is a strong contributor to our overall results. That's how you get into a situation where we have a 290 basis point increase in our margins for the quarter, despite having some volume headwinds in a handful of different markets. There's a couple other markets that also were impacted. Brazil was a decline. It's not a price volume trade-off that we're talking about there. Now Mexico maybe is a little bit of a different story. Now in Mexico, in Q3, we did have a decline in volumes, but that was driven on a comparability with Q3 last year, where we had a temporary boost in volumes due to it was a major competitor's plant that was down that increased volume significantly, and we had some large one-off type projects that came through our results in Q3 and in Q4, which were non-recurring volumes, basically. But it's not a trade-off in share or anything like that between price and volume that we're making. We believe in our focus on margins and our focus on pricing, and we believe it's a big net contributor to our results. Maybe on Ron, on the impact of incremental capacity coming on stream on Biskra and Unisem. Do we have anything on that, or we can maybe get back to Robert on that? Okay. And then on your last question, Robert, on where we are in terms of are we consolidating Biskra? Yes, definitely. We consolidate Biskra, and it's in our results. And I think you had a last question, which was on in terms of our fuel conversion, and are we ready to go from a fuel standpoint?
I think you said before it was going to be in Q4. But
we are. We are not going to be held back in Q4 because of energy at all. We've got that part behind us.
Can I just ask you, the supply of fuel there won't be local, presumably? It will be imported? Well,
energy supplies locally are also improving as well. And, the local dynamics of energy supply are improving. Okay. So not only is there more availability, but it also reduces the cost for us as well.
Okay. Thank you very much.
Thank you.
Thanks a lot.
The next question comes from Gregor Kuglitsch from UBS. Please go ahead.
Hi there. I've got a few questions as well. Can you just actually remind us what your energy bill is in sort of Swissy billion or Swissy 100 million or whatever for this year, so we can get a bit of a sense, so we can do our own math on that. First question. Second question is just in terms of the sort of implied fourth quarter, which I think, if I do my math correctly, implies something in the neighborhood of 30% EBITDA growth. And I understand there's obviously country-specific issues. So can you give us a little bit of maybe color as to, sort of, for instance, in Nigeria, what the headwind, how that converts into a tailwind, and how we sort of come up with that kind of number for the fourth quarter. Those were my two questions. Thanks.
Ron, you want to take the energy bill?
Yeah, total energy bill is 3.5 billion Swiss francs for the full year. You asked a question about how we're going to grow the EBITDA in Q4. So, as said in the earlier question, there's a few things to look at. One is the pricing exit September was 30 bips over sequential Q2 for cement. That means if that price holds in Q4, which is something we factor in, then you would have already 130 to 150 million of additional adjusted operating EBITDA. Second is, as Eric just mentioned, we'll have tailwind in our energy cost still. That provides another 30 million. And then we have the additional 100 million of synergies. So those are the elements that I would want to guide you on.
Yeah, and sorry. But your question specifically on Nigeria, kind of what's changing the situation in Nigeria? You had everything hitting us negatively in Nigeria in Q3. You had prices still at extremely low levels for the whole quarter. In fact, the significant price increase wasn't put in place until really the end of Q3 and even going into the first part of Q4. And so you had that affecting us in Q3, which is finished. You had this lack of energy supply, which drove a 26% decline in our volumes in the quarter, and we can now produce. Our plants can run fine now. So we're confident that just putting those two topics largely behind us, that Nigeria will be a good contributor for us in Q4, both from a year-on-year standpoint and also going forward as well. And then and the other piece, and I re-emphasized this in an earlier question, why are we confident on the outlook going forward? It's also India. And if you look at the comparable for India in the India Q4 2015 versus extrapolating kind of volumes and price logically into Q4 this year, it'll show a strong improvement as well.
Thank you. So maybe one final question for Ron. Can you update us sort of if you look at all the disposals that you've done? I think there have been a couple of since the last quarter, and perhaps sort of the dynamics have changed a little bit. How much we should be taking out for next year in terms of EBITDA and sales?
Yeah, if you look at slide 21, you get an idea of the scope impact on the right-hand side of the full year. So it is in line with what I said in the last quarter. So the full year impact is around 600 million. You can see that. Now you will also see that Lafarge India was already reported discontinued operations at the end of 15. So of the 600 million, 100 million was in discontinued operations. So if you do the math on the compare between 17 and 16, you would take actually 500 million for 2017 over 16, realizing that also what I just said is the 145 million that we already have factored in for the announced investment in 2016. Yeah, so
it's a 230 plus 310 basically. So that's 540 less 145, so approximately 400 next year.
Yes, close to 400. Yeah.
Thank you. Thank you very much.
The next question comes from Robert Gardiner from Davy. Please go ahead.
Good morning, gentlemen. Thanks for taking my questions. Just two quick ones for me as well. Could you give us a little bit more detail on the additional cost initiatives you mentioned there, UK, Germany, and maybe some updates on your thoughts around the UK market since the vote in June. And likewise, just to come back on pricing then, I'd just be interested, again, to come back on Europe and just looking there in terms of the detail you provided in the presentation, and you have 10 markets showing pretty significant declines. I'm just wondering, with the volume environment seeming a little bit better there, should the pricing be coming back? And likewise, you would have mentioned at the dinner we were at in London, you were talking about a $20 per ton price increase in the United States. I'm wondering, has your thinking changed at all there, given the Q3 weakness? Thanks.
Okay. A bunch of questions. There's two quick questions. I think there's five I got in there, but But let me go through them real quickly. So additional cost savings. So yeah, what's the point that you see 100 million of additional cost savings beyond the synergies? And it's what I expressed at the Capital Markets Day last year, and we repeatedly is that our cost savings initiatives don't stop at the synergies. So what the synergies are unique things we're able to do of bringing these two companies together. But in addition, we've got ongoing cost improvements in alternative fuels and in maintenance cost expenditures, and really focusing on our fixed cost reductions. And that's something that's ongoing in all of our markets and will continue to be going forward. We'll have more details on that on November 18th when we get together. The UK, as you know, in our business, it's a local business. So our volumes, and especially in the UK, it's really a UK business. So we don't have imports or exports of any significant nature coming in. So it's very much tied to underlying activity in the UK, which with large projects going on so far in Q3 continues to go fine. And our business in the UK will be impacted going forward as the economy in the UK evolves. The only immediate impact, obviously, is the foreign exchange impact as you translate the results into Swiss francs. And then on price in general, what's the outlook on price in general in Europe? Certainly, it's an important focus for us, and we're looking at that in a lot of areas, and we believe that we'll be able to show improvement and in across the board in Europe. That being said, when you look at our results in Europe in Q3, we've done a great job on costs, and the teams in Europe really have done a fantastic job. And you look at Europe EBITDA growth of 16%, that's a great result, and we're very proud of the team and what they've done there. In the U.S., you asked specifically about pricing in the U.S. As I said at our dinner, we've announced a price increase of $20 a ton in the U.S., and that's something effective for next year. And we'll see what the final impact of that is in the market. But we believe that we'll have a very attractive price increase in the U.S. in 2017. I can't get any more specific than that right now.
Okay, that's great.
Thank you very much, Albert.
The next question comes from Arnaud Lehmann, Bank of America Merrill Lynch. Please go ahead.
Thank you. Good morning, gentlemen, and the IR team. Two questions for me. Firstly, probably for Ron, could we discuss your refinancing strategy? The last bond you issued, $1 billion in US dollars, very long maturity. One part of it is 30 years. I guess that's good. On the other hand, the coupon 4.75 feels a bit high compared to current conditions on the credit market. So it feels like you're making a trade-off between a very long maturity duration and the actual cost of this bond. Considering that 4.75 is actually not very far from your current average cost of debt, and some peers in the sector have issued bonds at a much lower cost than this one. So was it a one-off, or could you please elaborate on this? And my second question is coming back on your CapEx. I guess we see a significant decline in expansion CapEx as expected, but also a small increase in maintenance CapEx. Do you believe we could see more of that going forward? So further decline in expansion, but also maybe sort of slightly higher maintenance.
Okay, thank you for the question. So let me talk about the strategy we have on refinancing. Yes, we have clearly sought to extend maturities of loans, and if you look at page 22, and I said in my prepared remarks, that has led to an increase of the duration that's quite significant. Are we doing that at any cost? Certainly not. We, of course, went to the U.S. market, which, as you know, is a somewhat higher priced market than the Euro market, but we also are a big player in the U.S. market. So we also need to finance operations there. Second, for Triple B, I believe that with the 10-year as well as the 30-year that you allude to, we've gotten actually quite favorable pricing, and there was practically no new introduction premium. So it's clearly done at very competitive rates, and with the target to enter a deep market like the U.S., where actually as Triple B we can get to 30 years. That has been one of the prime objectives, but certainly in our book at economic terms. Now, we've also done quite some liability management, and we did a bond withdrawal of one of the older Lafarge bonds of 4.75 of around 500 million. So I would say this is a clear, great exchange between shorter duration and longer duration at very economic pricing.
In terms of capex, I wouldn't say that there's an increased trend in maintenance capex. It's just our maintenance. In fact, we're looking to maintain or reduce our maintenance expense over time. But we are, from quarter to quarter, we will invest what it takes to do a good job maintaining our plants. But the maintenance capex envelopes that we have in place and that we've set as a target as a part of our overall capex plan going forward, we're running underneath that level. So we're confident in our ability to maintain our assets at a good level.
That's great. Thank you very much.
The next question comes from Mike Betts, Jefferies. Please go ahead.
Thank you very much. My two questions are on volumes, firstly, and then secondly on India, please. On volumes, Q4 last year was actually quite strong. I think volumes contributed 91 to EBITDA. I mean, you've talked about the countries where they were weak. Is there some risk where countries were strong in Q4 last year that they could be significantly weaker this year? And just on Nigeria, on fourth quarter volumes, your competitor is talking potentially about volume declines in Q4 because of the big price hike. Did you have production problems last year that would allow you to maybe raise the volume in Q4 this year? And then secondly, on India, just a two-part very quick question. The two subsidiaries, I think, reported a lower operating EBITDA, but you're talking about an increase. Is there some accounting difference there? And then secondly, I think the businesses have been merged now. Is there some cash impact? I seem to remember when it was first announced that there would be. And what would also be the impact on EBITDA? Thanks.
Sorry, wait, the last question was what, Mike?
On the Indian business, the ACC and Ambuja merger, I think at the time it was announced there was going to be a cash inflow from that. Is there, and also will there be any impact on the EBITDA that you report from that merger?
Okay, well, let's start with that. There's no merger that's announced in India, just to be clear on that. What you're referring to is that we had a restructuring of our ownership structure in India, whereby 500 million of Swiss francs was essentially brought back up to Switzerland as a part of a restructuring. But there's no merger that was done, and that was done in August. So okay. Coming back to the first question on volumes and the comparable versus Q4, and you're right, volumes were up, were good in Q4, and what we attributed it to mostly then is weather, and we had an extended weather impact or favorable weather impact in Europe and in North America last year, and so the comparability is really more based on Europe and North America weather compared to last year.
And do you assume normal weather this year then, or again good weather?
We assume normal weather, and we're in I don't know where you are today, Mike, but you look out I can tell you here in Zurich it's beautiful and sunny. So. That's not a specific volume forecast, to be clear, for Q4. And then in Nigeria, your question is, so we're watching the market closely in Nigeria and overall market trends. There was a very significant price increase, and we're watching the evolution of volumes. And I can't really comment on where specifically we expect volumes to be in Q4, but it's a topic that we're watching closely. However, the effects of our cost reductions in Nigeria and the price increase, we're confident that Nigeria will be a solid contributor of incremental EBITDA growth in the quarter.
Okay, and I'm not sure you got my other one on India. The difference where your adjusted EBITDA is up for India, but ACC's and Ambuja seems to be down. Is that an accounting difference with some one-offs? I'm just trying to understand the comparability between those two sets of numbers.
Between which two sets of numbers?
The reported declines in EBITDA by ACC and Ambuja.
Yeah. I'll let Ron ask, but I just wanted to finish one point on Nigeria.
Sure.
That's important to understand. In November of 2015, we had fairly significant flooding in our Calabar plant in southeastern Nigeria that really held back production significantly in southeastern Nigeria for us in Q4 2015. Now we have even a new line in place there. So yeah, there's some market things to watch closely in the market, but we also we don't have the flood effect on us as well. And maybe Ron, I don't know if you could address Mike's question on India.
Well, we have to realize that in India they report on a local GAAP basis, so the two don't always necessarily add up to the consolidated number that we have.
Okay, so it was that rather than a one-off item or anything specific.
Yeah.
Yes.
Yeah, it's nothing between India and us. It's difference in Indian GAAP and in IFRS.
Understood. Thank you.
The next question comes from John Fraser-Andrews, HSBC. Please go ahead.
Thank you and good morning. The first question is just back on the market share. I heard clearly what you said, Eric, on some specific markets, but if I can just put to you, in Mexico, the market leader there reported volume growth of 10% in Q3. And I hear what you say on your non-recurring gains in the base, but now, if you strip those out, would you still maintain that you saw a similar growth to the number one player? And likewise in India, the market leader there reported a very small increase in volume, yet your volumes are down 8% as I calculate. So just like to hear about those two countries specifically. Second question is, could you just outline the specific actions you're taking in Indonesia and Malaysia to improve profitability? And finally, looking into next year, are there many specific emerging countries which you're concerned about in terms of weakness, or are you generally looking forward to better demand prospects across your EM network? Thank you.
Okay, good. So let's talk about Mexico and India. And there are two very different situations there, but both end up with the same message, which is if you look over time, we don't expect to be having an eroding market share, and that's what we see. That's in our business plans, and but to go and try to measure that on a quarter-by-quarter basis is quite difficult, in fact. And so you take the example of Mexico, where specifically to us, when a competitor plant went down last year, there was a big boost in volumes for us in Q3 last year, and we had some one-off non-recurring project work. But if you look at our share over an extended period, we believe that we're not losing ground in Mexico. In India, you had the effect of the monsoon, and yes, we did make a real push on maintaining price levels in India, and a part of the market did grow or was slightly flat to slightly declining, and our volumes went down more than the overall market in Q3. But we don't expect this to be a trend going forward. We expect to maintain our share in India. albeit at a higher price level than otherwise. So your next question, John, was on Indonesia and Malaysia. So we have actions going on in both countries, and the nature of the issues are a little bit different, in fact, in the two countries. But the one thing in common is excess supply, and we have new capacity coming on stream in both of those countries. In Malaysia, we're focused on our plant performance. Our plant performance wasn't as good as it should have been, and we're very focused on improving our plant performance there. And we've got specific cost reduction actions associated with improving our plant performance that we were expecting to drive, and the teams are mobilized in place. But it's really, our focus there is on manufacturing industrial costs and fixed costs in particular. And when plants don't run well in one part of the country, it increases our shipping costs as we have to ship additional distance from one plant to another. So we see that we can respond in part through cost reductions. And we also think it's a market that's going to rebound better from a pricing standpoint, probably than Indonesia. In Indonesia, you've got a significant excess capacity in the country right now. And we're also focused, obviously, on our costs, but there's also a big piece of our costs which are logistics, and we've made good progress on our logistics costs, and we continue to see that there's more opportunity to take costs out of our logistics, and we're looking at our fixed costs as well in Indonesia. In terms of what emerging markets we expect to see problems in going forward, I don't know that there's any new ones that I have a crystal ball that I've identified, but I don't expect that the situations in Indonesia or Brazil will significantly improve or turn around. I expect we're bracing our cost planning and our expectations for probably difficult markets in Brazil and Indonesia going forward. But our other markets that have been a bit more of a challenge this year, for instance, Nigeria, we see between pricing and our cost improvements and our new line on stream, us to be able to deliver much better performance in Nigeria next year than compared to this year. And other areas that were more difficult this year, we expect, for the most part, our emerging market portfolio of countries to be a strong contributor to our earnings in 2017. And that'll certainly be one of the messages that I'll be emphasizing on November 18th.
Just a quick follow-up to that. You seem to have had some good progress in Middle East Africa outside Nigeria, specifically in Algeria, Egypt, Iraq. Are you seeing the benefit of higher oil prices and more optimism in that region generally?
Yeah, I don't think, no. We're not necessarily seeing the effect yet of higher energy costs. I think it's too immediate to see that. I think you're seeing good focus on price and costs in our teams there. And, as Ron said, in Egypt, the team has done a great job on costs. Lebanon, you didn't mention Lebanon. Lebanon team has done a fantastic job this year. So it shows that in our emerging market portfolio, and this is one of the major messages I think that people should take away from our results in Q3, is that our diversified portfolio allows us to have very strong performance in a wide range of different countries, which more than compensates for challenges that we may have in one or two markets in a quarter. And it allows us to consistently and comfortably drive improved earnings. Next quarter, Nigeria, for instance, will be a good contributor to our earnings year on year. So we think that the emerging markets will be a good plus for us going forward.
Thank you.
The next question comes from Glynis Johnson, Deutsche Bank. Please go ahead.
Hello, morning everybody. I just have one actually. In terms of your full year 18 targets, they're on a like-for-like basis. So I'm wondering if you could just help us out in terms of what the annualized FX impact that you've seen so far in terms of the movements would be. You've obviously given us it for the full year, but I'm just wondering annualized what that number is likely to be.
Yeah. When we get together on November 18th, we're going to update our targets for FX and for scope, because as you said, they were like for like set. So that's one of our messages we'll have on November 18th. So I'd prefer not to get into detail into it now.
Thank you.
Thank you very much. Okay, so maybe a last question.
The last question comes from Manish Beria, Societe Generale. Please go ahead.
Yeah, hi there. Good morning. I had just one question. If I look at your Asia performance, so like for like EBITDA grew by 7% in this quarter. If I quickly do the math, the local subsidiary in India, Philippines, and Indonesia together, which is 50% of the Asia, reported a minus 5% decline in EBITDA like for like in 3Q. So this implies, the other 50% of your Asia business has grown by something like high teens. So I just want to understand which are the markets in Asia which give you such a good performance in Asia.
Yeah, I think your analysis is pretty good. So, the Philippines has done a great job, and the Philippines market continues to perform well, and China as well. And we've seen the effects of our synergies and our cost reductions in China falling through to the bottom line. So between China and the Philippines, it's been a good contributor to our Asia results.
Okay, thank you. Maybe I will ask one more question. So, like you have taken so much of price hike in Nigeria, but what we see in Nigeria is a very slowing economy, because of the oil prices and the public budget that has been on strain. So do you think this price hike will hold for the Q4, or you have to take it back at some point in time?
Oh, we're confident. What we see is the price increase holding.
And what is your percentage of energy requirement in Nigeria? That is met through imported sources, the energy requirement in Nigeria. How much is sourced from the imported one, and how much is local?
Hang on, let me just check for that number. Well, I don't, Ron, do you have a number on that, or we can get back to him?
We'll get back to him.
Yeah.
Okay.
It's a very specific country. Yeah. Okay, well, I'd like to thank everyone for joining us for the call today. Great questions, I appreciate them. And we'll have an opportunity to exchange in more depth on November 18th. We'll update our key messages for you, and we'll certainly have many opportunities to discuss all your questions.